Hi, everyone. Thanks for joining us for today's webinar on charitable gifting. I can't think of a better time of year to talk about charitable gifting, especially during this crazy year of 2020. We'll be talking about DAF funds, which provide an easy and great solution for your year-end charitable gifting, along with your tax deduction. DAF funds have actually grown exponentially over the last 10 years, starting at $10 billion 10 years ago to over $120 billion today. And the main reason is because of the convenience and ease of setting up these charitable accounts. So to help us with discussion today, we have Stephanie Diamond from Charles Schwab Charitable, who's been with Charles Schwab Charitable for over 11 and a half years. I believe, Steph, is that correct?
Just about 11, that's right, Tom.
Yeah, time goes fast, and I'm sure you're incredibly busy this time of year.
I am. But
just real quick housekeeping item, we will have time for questions, so feel free to ask our question before the end of the webinar. So go ahead, Steph, I'm sorry.
No, I was just saying it's busy, but it's a pleasure to be here.
Well, thank you very much. Very, very important for sure. You know, especially during this crazy time.
It is. Well, it is just 4:01, and so if I see participants are joining now, but we can get started in just a minute. And I think I'm also going to be followed by your colleague, Michael, correct?
Correct.
Okay. Michael.
Hello.
Great. Well, before I share my slides, I just want to thank you, Tom and team, for having me on the call. Tom didn't mention this, but I've been at Schwab for a little over 20 years, and I've known Tom for that long, and his team. So it's always wonderful to partner with a firm that you've known as long as I have and been able to do really great things for our clients. So we're excited to talk about some year-end strategies. It is amazing. It's December, and Tom's right, this is our busiest time of the year. And especially this year, because with the election, there were a lot of clients and advisors who were waiting to see the outcome of the election before they were going to finalize their end of year planning. So if you haven't finished your own planning, you are not alone. You are in good company. And the idea of the time today is to talk about some strategies that you can either implement now before year end, and some things that you can also consider for next year too. So let me share my screen. And I want to talk about now this 3 considerations as it relates to charitable giving. And these are specifically important for this year, 2020. You see in the green circle, continued need. It has been an unprecedented year of need. I feel like I don't even need to say that. We all know what's happened with COVID-19, the social justice issues, as well as the natural disasters that have barraged us this year and years in the past. So that has always been the case, and this year again, just even more so is the need that's out there. The second consideration for charitable giving are the markets. Many of you are working with Meyer Capital or have other advisors, so you are in conversation with them about your portfolios. And I just want to make a point that it is important to talk to your advisors about the fact that you do give to charity, because when we have markets that are like this today, in some cases, there might be an opportunity to rebalance your portfolio or trim positions. And if that's the case, instead of incurring capital gains tax, then you might want to consider the assets that you have in your portfolio to use for charitable giving. So that's a really important piece of what's going on today as well. And we're going to talk a little bit more about that. And the third piece is tax rule changes. As I said, the election was definitely something people were keeping an eye on related to tax rule changes. And I would say that even after the election, as we face 2021 and we're thinking about the Senate race, it's still really unclear what is going to happen from a legislation perspective. And so the point I want to make is that even though some things may change going forward, we're unsure of what those are. And so there's a lot of things that we need to consider right now based on some legislation that's happened in the past. And I like to make the point here too, that when you look at these three circles, we give because of need and things that we're motivated by. Either that is what we see in the world in our own experiences or what's happening in our own families. But really good tax planning and tax incentives help us give more to the causes we care about most. I want to start with the Tax Cut and Jobs Act, which was implemented in 2017. And I talk about it because it's good level setting for where we are today related to tax incentives and the charitable deduction. So when you make a charitable gift, if you itemize on your tax return, you can deduct up to a certain percentage of your adjusted gross income for your gift. If you give to cash to a public charity, or as Tom mentioned, a donor advised fund, you can deduct up to 60% of your adjusted gross income. If you give appreciated securities that have been held over a year, so think about your stocks or your ETFs or your mutual funds, you can deduct up to 30% of your adjusted gross income. The value of appreciated stocks, though, as I mentioned, is that when you give those to charity, you're not incurring capital gains as if you would when you would sell them. So that was 2017, and that 60% AGI deduction was actually an increase from years past. But now 2020, and we have the CARES Act, and Michael and I were just talking about the different changes and strategies that advisors and clients are talking about because of the CARES Act. But there are really two things that are related to charitable giving for this year. And the first is that if you are giving to charity and you don't take, if you don't itemize, you can still give this $300 above the line contribution so that you can deduct it on your return, even if you don't itemize. And I just would say here, $300 doesn't seem a lot, but when we talk to charitable organizations, especially this year, there's such great need, they really would appreciate that gift as well. So if you're going to do that, don't forget to talk to your advisor about putting that on your tax return, and then consider it as well if you aren't itemizing. The second piece, and I'm going to go into this in more detail, and we sort of called this the buzz of 2020, was this opportunity for donors to elect 100% of their adjusted gross income as well. And both of these, as you can see, are cash donations only, and they have to go directly to an operating charity. So it can't go to a donor advised fund, private foundation, et cetera. It's got to go to those organizations, social services, art schools, et cetera. So I'll talk about this 100% AGI deduction in just a minute. But again, these are the tax incentives that exist today in 2020. And with this, we're going to go into some strategies that you'll want to consider and how that donor advised fund can be helpful in that as well. So let's talk about the first strategy, and that's utilizing your best assets for giving. I talked a little bit about using appreciated assets, and I just want to give an example of why this is important, because so many of our clients are not talking to their advisors about this. They're writing checks, they're using credit cards, and they have these appreciated assets in their portfolio. And so you can see here, it's two examples. I used to, sometimes I talk about this in terms of option one is Jack, option two is Jill, their sister and brother, and they're both being asked by their alumni to make contributions. And so Jack, he's going to say, well, I have this asset that's appreciated from 5,000 to 50,000. Here's my long-term capital gains, and I'm selling it. right? I'm going to sell this stock. I think I'm going to sell the stock and I'm going to give the organization the cash. But look what happens. Jack has to pay capital gains tax. So in that case, because he's paid that $6,750, he has less of a charitable contribution to give and therefore less of a tax deduction to take. So you can see his tax savings. Jill, she's talked to her advisors first, and they've said, don't sell, just contribute the appreciated security directly to the charity. You won't incur any capital gains tax, and then you'll have a larger contribution of $50,000. And you can also see then she has a bigger deduction that she can take as well. And this is in the case that she itemizes. So in the second case, she was able to save an additional $8,370 by contributing that appreciated asset. I also like to make the point here that, of course, publicly traded securities and funds are the most that are received by charities, but there's a lot of other assets in our clients' portfolios that I'd just like to bring up, because you might have them and you might not think, oh, I can't use this for charitable giving. But again, anything that is highly appreciated that then can be liquidated is really a great asset to consider for your giving, because if you sold it, you'd incur the capital gains that I mentioned. So just take a look across these. I work with a lot of clients who own their own businesses and their cost basis was zero, or they have restricted company stock that they've had for years and years that finally vest. And then even real estate, second homes or land can be great considerations as well. So let's move on to the second strategy, which is for those of you that are older than 70 and a half. And this is about using your retirement accounts. So you may recall, and many of you have taken advantage, I'm sure, of using your qualified charitable distribution, which allows you to give up to $100,000 directly to operating charities. So again, not a donor advised fund, but those social services organizations. And that's always been an incredible strategy. You don't have to face ordinary income of 37%, and then ultimately it does reduce the value of your IRA.
Steph, excuse me, that's very, very important to talk about the QCD not being able to be put into a DAF. There's sometimes confusion out there, and that is an absolute no-no, correct?
Yes, you are able to take your QCD and give it to an operating charity, but you cannot give your QCD to a donor advised fund. So let's say this year is a very unique year though, because with the CARES Act, you don't need to take your RMD, but you still may want to use your QCD. And the reason why it's important to think about that is because you are charitably inclined, you can still avoid the ordinary income tax rate, and again, it reduces the value of your IRA. But because you don't have to take your RMD this year, there's another really interesting strategy that we're talking a lot about, which is thinking about a Roth conversion and then offsetting that Roth conversion by making a charitable contribution and getting a charitable deduction. And this, Tom, is where the donor advised fund can come in. If you have an IRA and you're over 72 and you don't have to take your RMD this year, then you're not being faced with the tax that you normally would have incurred. So now you can say, well, if I want to convert that or some of that traditional IRA into a Roth, then what that'll do is, if I think about my heirs who are receiving my IRA, it will reduce the tax that they would incur when they received that after I pass. And so again, you're going to face a tax by having the Roth conversion. So in that case, take some assets, contribute them to charity, and claim a charitable deduction if you itemize. And again, this is, as I mentioned, and I'll talk about this in a little bit, when you can consider using the donor advised fund. So let's talk about the third strategy, as I've alluded to in the beginning, and that is related to this charitable deduction. Right? So I mentioned, if you do not itemize and your tax return, you can still give $300 above the line. And then strategy 2 is this 100% election of cash gifts in 2020. And we had a lot of conversation about this within Schwab. Tom and I even talked about this last week about the benefits of taking this 100% AGI election or not. And we ran some calculations, and so I wanted to share some of these with you just to show that in some cases it does make sense to take this 100% election, but some cases it really doesn't. So there's 2 examples here. And again, this money that goes out has to be cash only, and it has to be to an operating charity. So you want to be able to say, I want to give a lot of money to certain organizations this year, and I'm in a specific tax situation that makes this beneficial to me. So if you look at tax 1, you can see here how a client might have an adjusted gross income of $1 million. They can take a charitable deduction and offset that $1 million of AGI. And then in 2021, they still have that same $1 million. They're not giving, and they're taking the standard deduction. So you can see they have no taxable income in 2020, but they'll have taxable income in 2021. They won't have any tax due this year, but next year they will. And so the tax over the 2 years is, you can see, $297,000 plus. The reason why I'll talk about scenario 2, and this has to do with using the default 60% deduction in 2020. You're still giving the same $1 million, but instead of electing that 100% deduction, you're saying, you know what, I'm only going to take my 60% deduction, and I'm going to carry forward everything else that I didn't deduct. And I didn't mention, when you are able to deduct a certain percentage against your income, if you can't use everything, there's a 5-year carry forward that you're able to take. So in this case, this client carried forward what he wasn't able to deduct against his income. And in this case, it was $400,000. So you can see his taxable income in both years. But because of the tax brackets and the way the calculations work, you have tax brackets at 37%, 35%, and it drops from there. And as you go through each tax bracket, it wipes out that tax bracket and moves to the next. And so in the scenario 1, they went through all the tax brackets, but in scenario 2, they said, you know what, I'm only going to utilize the 37 and 35% tax bracket. I'm going to carry forward the rest, and I'll use that 37 and 35 the following year. And that is what enables the larger savings in tax somewhat and seem somewhat more complicated, and I will confess I am not a tax advisor or even a retired one. So I would really strongly suggest talking to your advisors about this scenario, what makes sense for you. I now want to talk about one of my favorite strategies, which is bunching, and this is really related to the charitable deduction that's been put into place since the Tax Cut and Jobs Act. Many clients since 2017, their deductions were reduced, and the standard deduction was increased, right? So you can see here that the standard deduction is now $24,800. And you have a client situation where they have deductions at $13,000 each year, and then they make a charitable contribution and a charitable deduction of $10,000. You can see they're taking the standard each year. So what if they bunched that giving and took $10,000 and put $20,000 of 1 year? Well, now you can see in 1 year they can itemize. The following year they have to take the standard, right? Which is again that are not giving, and so the standard is the $25,100. But because they actually itemized in 1 year, they were able to save $8,200 of additional tax deductions over 2 years. So again, if you have the extra capacity to do this, it's something to really consider so that you can then think about using tax incentives to minimize your taxes and ultimately have more to give because you have additional tax deductions. Now, I'll stop here for a second, and if any of you have ever faced this, you'll understand what I'm going to say. in this case, if you think about bunching and that 20,000, you're probably not giving that to one charitable organization. But as we talked about the unprecedented need, maybe it makes sense to give $20,000 to the organizations this year. But in most cases, that's not what donors want to do. And that's not even what charitable organizations want. They prefer that $10,000 in this year and that $10,000 next year. So how would you be able to do that? By getting the tax deduction that you need of $20,000 and then being able to spread your giving over the 2 years that you normally do. Well, this is where the donor advised fund comes in and has been a really great vehicle for the strategy of bunching, along with other things. So the donor advised fund, as Tom mentioned, is actually, it's an account and it's administered by a public charity. So I work for Schwab Charitable. And the reason that having this account administered by a public charity is important is because when you contribute, let's think of our example of the bunching, that $20,000, you get the same deduction as you would by giving to another 501c3 public charity like the social services, museums, etc. You get the tax deduction the day the money is contributed into the account. If it's appreciated assets, it becomes the fair market value of those assets. And then those assets are sold inside Schwab Charitable, the charity, which means no one is incurring the capital gains. So now you have the $20,000 inside your donor advised fund. I'm going to talk about the investment options in just a minute, but then you can give that money to the organization of your choice over time. And in this case of the bunching, it might be $10,000 right away and $10,000 the following year, just like you would normally do. If you also think about all of these charitable organizations that you might be giving to, you're now making one contribution into the donor advised fund, and we keep track of all of the gifts that you give out instead of having a spreadsheet or what I like to call a shoebox of receipts. So I want to share here what it looks like to make a grant, and then we'll talk a little bit about the investment options. And as I move here, and Tom, you had asked me to show what it looks like to make a grant. We actually just changed and enhanced our grant flow, so I'm really excited about this. So the benefit of the donor advised fund, if you have other Schwab accounts, is it's linked to your other Schwab accounts. If you're working with Meyer Capital, they link it as well, so they can see all of your accounts in one place. So you get to search for your charitable organization, and we have a whole database of all of the nonprofits that are registered with the IRS. So that's millions. Once you find your account, the charitable organization that you want to give to, you can decide how much you want to grant, as you can see here. And then you can decide if you want to have this a one-time gift or a reoccurring gift. You can even dedicate the gift to someone, have it be in honor of someone. And then this is the best part. You can actually decide how you want the gift to be used. Do you want it to go for a special purpose or just generally to the organization for their choice to use it? So we've created lots of drop downs that you can choose from that enable the grant to go out. You can even see here annual gift. You can even see membership, but you're not getting any benefit. So lots of ways to just quickly do a drop down. But in some cases, let's just say you want to do something very, very specific with the organization. You can actually customize a letter that you write in what you want to say to that organization. And that's what this looks like. So when we get your grant request, we will send out a letter that you've customized, as you can see here, and the check that goes out to the organization. You name this account. This one was called the John and Mary Client Test Charitable Fund. And you can be recognized in the way that you want to be recognized here. They were recognized John and Mary. You could change that if you'd like. You can include your address if you want to, or you don't have to. Sometimes I get the question, well, this is great. Why would I want to use a donor advised fund versus giving directly to the charitable organization, even with my appreciated assets? And I'll say, if you think about this, the organization's getting a straight check of $250. So much easier for them to accept that than process appreciated securities. We make that easy as a financial institution to do that. The second thing is, if you think about the gifts you want to give, sometimes maybe it's not just a straight dollar amount that you want to give, like $500. Well, it's much harder to say, I want to give $500, and how do I find the appreciated asset that matches that value? And then the other thing is, sometimes there's a better part of the year to be thinking about rebalancing your portfolio and using your assets in the best way versus when you want to give those to the organization. So again, as we talked about, it really separates your tax strategy and your financial objectives with your giving strategy and giving to those organizations that you care about most. So I want to just end here before I turn it over to Michael on what happens with the assets are in the account. We've contributed our $20,000 in appreciated assets. They can be liquidated immediately and then reinvested. We have a choice of mutual funds that the account can be invested in, and your advisors can help you decide what the best makeup of those fund pools are. And I like to make the point that we have some index funds, actively managed funds, and socially responsible funds. We also have an opportunity with a professionally managed account. And this is a $250,000 minimum. The one thing I forgot to mention, which is so exciting, is we just eliminated our minimum to open a donor advised fund at all. It used to be $5,000, and now there's no minimum. But if you want to use the professionally managed account option, it's $250,000. And then if you're working with an advisor like Meyer Capital, they will help you think about the best models of their investments that match, what your overall goals are. So that $20,000 that we talked about of appreciated assets, it could be liquidated in the account and then reinvested. If you think about a concentrated position that you might have that you're concerned about, wow, what happens if I sold this in the capital gains, but I'm concerned it's a risk. Now I can diversify. So now I can contribute that, liquidate it, and reinvest. But there's also something that's really exciting when you're working with an advisor, and we've had a lot of clients who are very, very bullish on their tech stocks take advantage of. If you put a contribution in, let's just say 20,000 of name your tech stock, and you don't want to liquidate it because you're really bullish on it, you can actually keep that contribution in kind in the account and then slowly liquidate it as you want to make grants and over time. So that's been really powerful this year as well for some of our clients who, again, are very excited about their own stock. Before I turn it over to, or the stocks, I should say.
Hey, Steph.
Yeah.
I can't emphasize enough how important the previous slide 15 of how easy to take the pressure off at year end for individuals that want to write 5 to 10 to 15 checks at the end of the year, and whereas they can just go right into the DAF fund, get that deduction, take a step back, relax, and then worry about that in January. It just takes all the pressure off for sure. Exactly.
I think we all feel obligated and compelled to do our giving in December because that's when we're hearing about it. But actually, when you talk to some charitable organizations, their books don't close until June. And so they're really happy to get grants between January and June. They're spending as much time as they possibly can just trying to get through the holidays, process what they're getting in. They're actually taking a lot of pressure off of them by getting your deduction and the deduction that you need, but actually doing your grant making in the beginning of the year. Thanks for commenting on that.
Sure.
I'm going to turn over to Michael and you in just a minute, but I want to go back here because what you're going to talk about, I know, is so important related to options and investing. And if you think about this donor advised fund, as you're listening to Tom and Michael, this again is an account, and it's an account for charitable purpose, but it's also an investment account. And one of the things that I really appreciate is that you think about what your goals are from a charitable perspective, And then you actually can say, well, how do I align my investments in my donor advised fund with my charitable goals? And that's really now what Tom and Michael are going to talk about. And so I think that's very powerful, and another huge benefit of the donor advised fund, which is being able to say, these are my values, these are the causes, and not only do I get to give to those charitable organizations, but I get to align my investments. So again, thank you both so much for your thoughtfulness and the way you support clients related to their giving. And Tom, I'll turn it back to you.
Thanks so much, Steph. Great job. We can further that the over 250,000 through Meyer Capital Group, we have the ability to set up customized portfolios. And it's very important because you can create an absolute legacy of this portfolio long after you're gone. And, one of the strategies that we offer is, I think it goes right from gifting from the heart and investing from the heart. Don't smile, Michael. Okay, so Michael Smithwick, our portfolio manager at MCG and our resident ESG expert, is going to talk about exactly what I just said. So go ahead, Michael.
Thank you, Tom, and thanks to everyone who took the time to log in and gave me the opportunity to speak about sustainable investing, because I do love to speak about it, as Tom can attest to. It's one of my favorite topics. But we created a sustainable investing offering probably 4 or 5 years ago, and we've seen a lot of interest in it and a lot of growth in it. What is sustainable investing? So basically it's there's no standard definition of it, but we look at it as investing in stocks and bonds of companies that are focused on positive environmental, social, and corporate governance practices. So how does that look in real life? The way we do it at Meyer Capital is we invest in mutual funds and exchange traded funds that are having a sustainable lens on them. So if we think about a traditional mutual fund or exchange traded fund manager, they're typically doing research and putting together analysis on companies using various financial metrics to try to determine what's the best company to put in their portfolio. Sustainable investing fund managers do the same thing, but they also add to it some non-traditional factors, like factors that fall under the area of environmental, social, and governance. And just as an aside, you'll hear sustainable investing called many different things, and ESG investing is one of them. And that's where that comes from, is environmental, social, and governance. But these managers are not only looking for companies that they believe are going to do well financially and have a good return, but they're also making a positive impact in these 3 areas also. So just to dive a little bit into what this means, there are many, many different factors under each of these areas. But environmental tries to look for companies that are making positive progress in reducing their negative impact on the environment, things like reducing their carbon footprint and recycling and energy efficiency and so forth. The social piece of it refers to basically how these companies treat employees, or people, I should say, whether it be their employees or suppliers or vendors, what their company looks like from a racial and gender standpoint, and how they interact with and treat the community that they do business in. So that's sort of the social end of it. And then the final piece of it, the governance piece, is things like executive compensation, composition of the boards, and sort of their political lobbying activities and where their contributions go. So that's just a piece of what environmental, social, and governance could be, but there's many other factors out there that are looked at, and it depends on the company that's being looked at and the industry and the sector that it's in. So if I break down the sustainable investment strategies into 2 main areas, I could classify them as exclusionary investing and inclusionary investing. So exclusionary investing is sort of an older school approach. It's been around for decades, and it's basically the fund managers are actively avoiding certain companies or industries, and sometimes even sectors, in a portfolio to line up with a certain mission or value. So a classic example of this is religious organizations. They've been doing this for a very long time, and they will actively exclude companies from their portfolios that don't line up with their beliefs and their teachings and their values. This has been known for a long time as socially responsible investing, or SRI. And I've listed up here a couple of the classic exclusions in socially responsible investing funds. But these funds still exist, and they still manage this way and do very well. The one downside of these funds, I would say, is the diversification aspect. So when, as a portfolio manager, in any portfolio we're putting together, diversification is really important. We want to get good, broad diversification across industries and sectors and countries to maintain or to reduce risk in the portfolio. And when you're pulling out full industries and possibly even sectors, there are a few holes in the portfolio, and that's gonna be less diversified than if you were investing traditionally. And in the end, when you look different than traditional, say, mutual funds or indexes, your performance is going to be different. It might be good different, it might be bad different. It really depends on the time period that you're looking at, but it's going to be different. So the newer type of investing that falls under sustainable investing strategies is inclusionary investing. And what this does is, instead of excluding things from the portfolio, it looks to pursue companies or add companies that are pursuing sustainable business practices. And the reason this is an area that has grown significantly in, say, the last 10 to 15 years. And the reason it has is because there's a lot of data now available for fund managers to use that they can incorporate into their process. There are many companies out there, but there are a couple of big players, namely MSCI and Sustainalytics, that dig deep into public companies and rate them from a number of different factors under that ESG umbrella. And so these managers can now take that data, incorporate it with all the other traditional data they pull in when they're looking at a company, and see how they're doing from an ESG perspective or an environmental, social, and governance perspective, and incorporate that into their process. Another type of inclusionary investing is factor-based thematic, where it might have a narrower theme involved in the fund, like a low carbon or an alternative energy or a gender diversity fund. Another type of inclusionary investing is impact investing. So this is investing in something where you can have a very measurable and known outcome. So a good example of this is the green bond area. This is also another growing area. And again, there's no clear definition of a green bond, but when you think about a bond, a company issues a bond, they get the proceeds from it, and they use it for a certain project. And in this case, in the case of a green bond, it's going to be a green project that has positive social or environmental outcomes. They can see where the money's going, and they can see how the project did, and they can measure the outcomes. So that's why, you know, they can measure the impact that they have with the dollars used for that. A classic example of this is Apple. So a few years ago, Apple issued two green bonds, to the tune of $2.5 billion. And they are using the proceeds from that bond, or those bonds, I should say, to move their entire operation to renewable energy. So they're doing things like building green buildings, creating energy efficiency programs and new programs for recycling and material recovery. So the proceeds from that bond are going to a known project for them to ultimately be 100% run on renewable energy. So I mentioned that there's a lot of growth in the inclusionary space. There's a lot of growth across the board with respect to sustainable investing. What we're looking at here is the Forum for Sustainable and Responsible Investment does a survey every 2 years. And they've been doing this since the 90s. I'm showing you the last 10 years here, but it basically gathers assets that are being managed in the US that incorporate some kind of ESG or environmental, social, and governance factors into their process. And you can see that in 2010, the assets were $3.1 trillion, and they just released the 2020 study a few weeks ago. The assets have grown to 17.1 trillion. So that's a 452% increase in assets over the last 10 years, managed according to these strategies. That's an average of close to 19% a year growth. So you can see the dollars are really flowing into this area. And I think that's a function of the strategies are getting more sophisticated with the inclusionary investing, with the data that's available. It's getting more interest from people. It's definitely getting a lot more press. It's had more press just in this year alone than I've seen in the years past. And you can see that playing out with the asset growth. So with all that said, why does one want to invest sustainably? From what I see and what I read and what I see mostly with my clients that I invest sustainably for is that it aligns with their values first and foremost. That's sort of their main reason for wanting to do this. Of course, they want a good return on their investment, but they want to know that what they're doing with their dollars is aligns with their values, and they can feel good about where the companies that they're investing in. And what I tell people is that this is not a perfect science, and it's an evolving space, and there's no perfect company out there. But there are definitely companies that are making a full force effort to move in the right direction. You'll see in the press, you see it a lot, pretty high profile companies making commitments and pledges to do better for the environment, to do better socially, to make positive changes in the way they run their businesses. Many of these companies also put out what's called sustainability reports. These are not required by the companies. And when you look at some of them, you can see there's a lot of effort and resource put into it. So yes, in some ways it's a marketing piece for them, but it really does show their commitment to this. And so as the dollars continue to flow in there, what I believe a benefit of this is companies are going to be more and more aware. And as high profile companies continue to do this, other companies are going to follow suit, especially competitors, and then smaller companies. So what that's going to do is promote more responsible companies out there. And it's just going to be a positive kind of snowball effect. And the more responsible companies you have out there, the more products and services you have that are going to yield benefits for the community and the environment. So I think it's all moving in a positive direction. And I think that it's, you know, on top of being able to align with your values, it's going to yield in a lot of other beneficial results. And I think the end all be all result is that it's going to build long-term value for these companies. I strongly believe that these companies are going to come out on top in the long run because they're just going to be better companies for it. And so we're going to build long-term values for the company. And what that's going to translate to is building long-term value for not just the stockholder, which is important in a public company. You want to build long-term value for the stockholder, but it's also going to build long-term value for all the stakeholders involved, like their employees, like their suppliers, like the community that they do business in. It's going to build long-term value all around. So I think it's a positive thing, and it's a very big reason to invest sustainably. So the last thing I wanted to just touch upon is performance. So I won't dig deep into performance, but there is what I believe a misconception out there that if you invest sustainably, you have to give up performance. That this type of investing underperforms, say, traditional investing. And you know, the data here doesn't show that's the case, and I don't believe that's the case. So what we're looking at is trailing returns for a 1, 3, 5, and 10-year period on 3 indexes of sustainable companies. So that's the first 3 bars in each of the time periods. The green, the gray, the black bars are all indexes of sustainable companies. And what I'm comparing them to is the gold bar on the right of each category. And that's the S&P 500. That's the S&P 500 you hear about every day on the news, just a traditional index. And the reason I chose these 3 indexes is that they're fairly comparable to the S&P 500 in the kinds of companies that they hold, but also all 3 of them have been around a long time, and they have a history that we can look at. This is real live history, and they've been around more than 10 years, so we can look at a 10-year period. So looking at the 1-year period, you can see that sustainable investing has significantly outperformed. Now, there are reasons why that's happening in the past year, and one of the big ones is that the price of oil has dropped significantly this year and has impacted the energy sector, which has also dropped significantly this year. Given that sustainable funds tend to either have a lower allocation to energy companies, or in some cases, they don't have any allocation to energy companies, they're going to benefit from that. So you see some pretty significant outperformance for the 1-year period. That's not necessarily going to continue. That's, you know, that's a short-term kind of anomaly. And at Meyer Capital, we're extremely focused on the long term, and we don't necessarily base our decisions and our investments on short-term periods. So as you start to look further to the right in the longer term periods, and even as far over as the 10-year period, you can see that sustainable investing is still either very much in line with the S&P 500 or in some cases outperforming the S&P 500 for a couple of these indexes over a long 10-year period. So I do believe that's a misconception. And I think a lot of this has to do with the advent of inclusionary investing and better diversification. You're getting better performance from that. And I think you truly can invest sustainably, invest with your values, and still earn the same kind of return you would have earned if you don't. And it'll allow you to do something that we like to say at Meyer Capital: you can invest well and you can live well, right, Tom?
Yeah, absolutely, Michael.
So that's all I had. And again, I appreciate your time, and I'll turn it back over to Tom.
Thanks, Mike. Very nice. We do have a few questions. Steph, I know the answer to this, but you can go ahead and answer this. One question is, can I use a DAF to leave money to my heirs?
Well, you talked about legacy as part of charitable giving, and I think that question can be interpreted in a couple of ways. So this is how you can leave money to your heirs with the donor advised fund. When you open an account, you have the opportunity to name account holders. So if I'm a family and husband and wife, I'll be the account holders. And then I can say, well, just like any other account, you want to think about your beneficiaries, whether they might be people, or if you are charitably inclined to think about your IRA, you might be leaving your IRA to a charitable beneficiary. So with the donor advised fund, you can say, I have my donor advised fund, and if something were to happen to me and my spouse, partner, then what happens to those assets? Well, if I have children and I want to have them take over the accounts for charitable purpose, that's absolutely fine. You would name them as successor advisors on the account. Unfortunately, well, maybe fortunately, because the money is earmarked for charitable good, but maybe to the children's disappointment, they can't take the money out and go use it to buy a car. So again, the accounts can be left to heirs for the continued charitable use. And I think what's been really interesting, and this came up a lot this year too with COVID, we got a lot of questions about how do I reconsider my estate planning? Do I have successors and beneficiaries on my charitable account? And from an estate planning perspective, when you think about leaving charitable organizations in a trust, in a will, and every time you want to change that, you have to change a legal document. What you can do is leave Schwab Charitable, again, which is a public charity, as the beneficiary of your estate, of your IRA, of your trust, and then name those charitable organizations that you want to give to as beneficiaries. And then if you ever want to change it, then you're just changing an account document and you're not changing a legal document. So we're seeing a lot of clients really take advantage of that. If they don't have heirs that they want to leave the account to, or if they want to do a combination of both, leave some of the account to their heirs to use for charitable giving, but also know that they are earmarking a certain portion to organizations that they've built a relationship with.
Is there a cutoff date for opening a DAF fund in 2020?
Well, when I started, I said I can't, it's still amazing that we have 3 weeks, but it still seems a lot of time. You can open an account in 5 minutes, actually, online, and then fund it too. If you have your assets at Schwab, I think, and your clients are working with you, Tom, you can help them open the account, but we can get things up and running pretty quickly. Yeah. And if the assets are at Schwab, we can move them over in a day.
And utilize the mobile app too, correct?
You can utilize the mobile app. But I love using the mobile app for granting. It's so much fun because you could be just anywhere and say, oh my gosh.
You're driving down the road and hear something on the radio. Guess what? Pull over and say, I love this. I'm going to put $500 into this charity. Boom, done in 5 minutes.
Thanks for saying pull over. Yes, do that.
Of course. So this kind of goes into what if I die? What happens? And can children add to an inherited DAF? So maybe you can explain that.
Oh, it's an interesting question.
Mhm.
Because and I'll answer it, but I want to start with something else, which is actually related to my own family. We started a donor advised fund, and that was actually to think about doing some things related to my dad, who had been a doctor at a hospital in Abington, Pennsylvania. So for any of you that are from the Philadelphia area, that's where I grew up. And we each could, even though open it in one name, but each of us can contribute and get a tax deduction because we're all adults, my mom, my brother, and me. And for our own benefit, we each wanted to contribute into the donor advised fund. And then we decided together how we were going to make those grants. So when the account is left to the next generation for their own giving, it becomes theirs to manage. So
Right.
if they become the account holders, and they can continue to contribute into the account as well. Now, let's say that, and I know you have multiple sons, Tom, so let's say that, and your own donor advised fund, if it's okay to say, but if you were to leave the account to your sons, they have a choice to either keep that account and manage it from a charitable perspective together, or down the line, and this does happen, eventually they could say, you know what, we really want to separate this and do some things individually in our own family.
But it's not called an inherited DAF.
Well, I not like a
Like an inherited IRA.
No,
Right.
no, it's not a technical term, inherited. There's no income or tax situation or impact when you leave a donor advised fund to the next generation.
Mm-hmm. So if self-directed charitable account worth over 250,000, we can set up a customized portfolio. I'm saying this, and you'll know why I'm laughing. Can you trade options?
But you're asking me? Okay. Great question. All right, so $250,000 or above, I wouldn't necessarily call that self-directed. You're going to be working with an advisor that sets, Tom and Meyer will set up a non-discretionary relationship with the client where they're still placing the trades in the account, but taking direction from you, right? So if you, going back to, let's just say you've got some positions that you're really bullish on and you want to contribute them in the donor advised fund, and you then want to work with Tom to say, this is really what I want to do, Tom can help implement that in Meyer Capital. We do, and this is sort of more of an IRS thing, need to have an advisor on these more actively managed accounts when they're doing more than just using the mutual fund pools. And that's like a 401k option, if that makes sense. So now we've got assets in an account, and Tom, you're helping the client, activate their recommendations. And so the question is, can you trade options? There's lots of different types of options and levels of options at Schwab. Some you can leave in the account for contribute, but you have to liquidate it right away. So I'd probably need to understand more about what that type of option is.
Yeah, I believe it would be, say, like an option level 1, whether or not that Schwab Charitable would allow that.
Yeah, we'll ask that option to be liquidated, and
right.
As you know, we've had a similar experience where there was a client, and we've worked with clients who have options. They contribute them into the donor advised fund. We liquidate them.
Yep.
And then they reinvest with you.
And what about your year-end consolidated list of gifts? And your reporting is excellent.
Thank you. In terms of year-end, so let's say that you contribute into a donor advised fund, and just like any other charitable organization, you get a contribution receipt. So that's what you use for your tax planning. But let's say you did that 4 times. you'd still get one consolidated document for your contributions. The other thing we do is we keep track of all the history of the grants. So that's great, because then those aren't taxable events, but it helps you see what you've done in years past. And then if somebody asks you for a gift, you can look back at your donor advised fund and say, oh, I already gave that already. Or, you know, that's how much I gave last year. I can do the same this year. So we try to give one statement. It's called the annual summary. It comes out in February of the previous year's activity, and it's available online for clients through the Schwab login, and therefore the Charitable portal, and also Tom, you as well, your team.
Okay, and I'm just going to end real quick. This isn't free. Let's talk about the fees.
Okay, that's great. So there is a fee. All donor advised funds charge fees, and it's tiered, and it starts at 60 basis points for the first 500,000. And part of the reason we charge is we send out all of the gifts. We keep track of everything, and we're liquidating those appreciated securities, so you can avoid your charitable charitable gains tax. And I am distracted for a minute because I just saw another question come in, and I think this is important to answer.
I did. I saw that too.
Yeah.
Okay, you can answer that.
Okay, so I think the value here, as we talked about, and we can sort of restate this, is that if you fund your donor advised fund this year with a contribution, you're getting the tax deduction. You want that tax deduction this year. There's a lot of reasons why donors want a tax deduction in a certain year. They might have a really high income earning year, right? And they say, you know what, this is the year I want to offset a lot of income. But you're not ready to give all of that money away to the charitable organizations, right? So that might be something you want to do in 2021. It could be something you want to do in 2022. It could be something you want to do in 2023. You are not required to give all of that money away in the following year or the following year after that. So to answer the question, yes, you can fund your donor advised fund before the year end with your cash or appreciated assets, and then take your time and give your charitable, gifts, which would go out as a check from your account in years to follow.
Okay, fantastic. I think that's about it. We are up to our allotted time. I can't thank you enough, Stephanie and Michael, and everybody. Thank you so much for joining us today. I hope we provided some much needed, useful information for year-end charitable gifting. Everyone have a great night. Thank you.
Take
Take
care.
care.